Welcome to Mortgage Talk 101 here on Super Talk 1270. Time to look behind the numbers. Buying, selling, refinancing. Mortgage Talk 101 addresses real issues in real estate. Now, live from the Super Talk 1270 studios, here's Mortgage Talk 101 host Joe Sheehan.
Good morning, Bismarck Mandan. You probably guessed right away, I'm not Joe Sheehan. Dave Flohr here, saddling up the stainless steel microphone, as Joe likes to say, Mr. Housing. And we got new guys all over the place here. Joey's on the board this morning. We just met as I walked in the door, but he has already got things squared away and handled. We went through our first tech issue. We have a guest this morning that we had to call in. We had to figure that out, but Joey handled it with ease, no problem. And Joe is on special assignment. He had to go out of town today. I guess he took the opportunity to go up to one of his branches up north in oil country, in Oil Patch, Joey. That sounds good, huh?
There you go.
All right, there we go. But, folks, we are going to jump right in with our guest this morning because we only have him for a half hour. Mr. Rob Chrisman. Rob, are you there?
I'm here.
All right. Rob is Rob, what are you? What actually do you do? You write a thing every day that I read every day. But beyond that, what do you do?
Well, my background is primarily capital markets. I started in the mid-1980s hedging pipelines and so forth and running a subprime company, and the list kind of goes on. But in 2008, I had officially retired from the industry. My mom had passed away, and I wanted to take care of my dad and take care of odds and ends and see my kids and spend some time with my wife. So I retired, except for sending the commentary out.
Okay.
And so the commentary goes out 6 days a week, but in addition to that, I do get tapped on the shoulder to do some consulting, some capital markets consulting, and also some speaking engagements, which allow me to travel around and give me the good fortune to meet with some nice folks around the nation.
Yeah. Oh, well, super. Sounds great. So we got somebody here that's got tons of experience. And Rob, normally when we have a guy like you on the show, Joe and I are usually both here, and what we usually like to say when we have a guy like you that obviously knows his stuff and is really smart is we that's a special episode of Mortgage Talk 101. We like to call it Two Dumb Guys Asking a Smart Guy Questions.
Well, I wouldn't go that far.
Yeah, but today there's only one dumb guy, so I don't know what you're going to get. But anyway, let's give it a whirl. Now, you mentioned that you travel, doing a lot of traveling, and actually you're going to be traveling to North Dakota here at the end of the month, and you are going to be speaking at our statewide housing conference that the North Dakota Housing Finance Agency puts on every year. But as you travel around, what's the mood of the mortgage industry folks these days?
The mood is good. The mood is very good. As a matter of fact, that I could argue that it might be the most optimistic I've seen in quite some time, because pipelines are good. Rates did not go up. In fact, rates are down, and there are a lot of originators out there helping borrowers refinance or buy homes, and I think the rates having moved down, and it's not so much rates have moved down because of what's happened here in the United States, because for the most part, the U.S. economy is doing okay, but rates have moved down because of what's happening overseas, which were unexpected, and so the smartest guys in the room were all saying the rates are going to go up. Rates have not gone up. They've gone down. And so this refi volume that has come through for a lot of lenders is a welcome surprise. And I think it'll help a lot of companies out there get through to the beginning of purchase season. So it's been welcomed. No one's going to look a gift horse in the mouth, and we'll see how long it lasts.
Yeah. Well, and like you said, getting to purchase season, which is real important up in our part of the country, because with winter, people tend to not like to move when it's got snow on the ground and it's 20 to zero out as far as temperature goes. So I'm sure a lot of the lenders up here were happy to see the rates come down, and they're getting refinance calls. And I just saw some. I think the last purchase index that MBA or last mortgage survey the MBA did talked about how the refinance had picked up. That was correct, right?
Yeah, it's excuse me. When you really start to slice and dice the numbers, it's interesting when you watch the purchase index and the refi index, and the MBA's numbers cover about 75% of the overall retail side of the industry, and a certain portion of those the refi pickup for applications, they attribute to the changes that the FHA made to the mortgage insurance premium, and so they're seeing a bit of an uptick there with FHA loans, which good for originators but bad for any investors that had purchased pools with FHA loans in them that they thought were going to have on their books for years and years are now refinancing. So, the MBA thinks, I think 2013, the industry did about 1.7, 1.8 trillion nationwide, and then last year it fell to about 1.1 trillion. That's those are the initial early estimates. And the MBA thinks things will tick up a little bit in 2015 to maybe 1.2 trillion or so. And I think a lot of that is due to purchase business.
Okay.
And as you note, for many parts of the country, purchase business doesn't really kick in until April or May.
Yeah.
And they, like I said, the companies are very happy to have some of this refi volume to tide them over until that happens.
Yeah. I actually just saw something where the Minneapolis Fed president, I butcher his name, Coach Lakota, he does not expect the Fed to hike rates at all in 2015. So that, to me, that kind of says rates are kind of just going to feed into this range that they've basically been in for the last 2 years, right?
I wouldn't be surprised at all if that happened. In fact, when I tell people, of course, no one has a crystal ball.
Yeah.
But, when I'm talking to folks, I will say I could easily be here a year from now talking to you, and we could have 30-year, 15-year mortgage rates and prices just where they are today. The thing for your listeners to keep in mind is that the Fed does not set mortgage rates. They set short-term rates like overnight Fed funds or the discount rate or the prime rate.
Yeah.
And so whether or not those translate into the 30-year mortgage arena remains to be seen. The 30-year mortgage rates are more set by supply and demand. So even if the Fed were to raise rates, and many still think they're going to raise rates in the middle part of the year, whether or not that relates to or results in a change in mortgage rates remains to be seen, especially if production drops a little bit and the demand is still strong out there by REITs and insurance companies and pension funds and banks and whoever wants to own the mortgage asset. If the demand is strong, rates could stay where they are now. They'll be snapped up. So he may obviously he's more in touch with the economy than I am, but I wouldn't be surprised if he was spot on. You just never know what's going to happen overseas. As I mentioned earlier, the U.S. economy is doing okay, but the rates right now in our country are more determined by what's going on in Asia and in Europe and what's the Swiss bank doing or the Greece back to dealing with problems in Greece, and so that's a real crapshoot when you start talking about the European community.
Yeah, and especially Greece, since we had the change in leadership there, I don't think anybody's really sure what's going to happen there. So,
no.
Yeah.
No.
Okay, well, and I guess, Joey is telling me that it's break time. We'll be back with Rob Chrisman. Rob, hang on with us, and we got one more segment left with you. We'll be back on Mortgage Talk 101. All right, Bismarck Mandan back on Mortgage Talk 101. Dave Flohr, Mr. Housing, sitting in at the stainless steel microphone for Joe Sheehan, who's on a special assignment up in the oil patch today, going to one of his branch offices up there. And we have with our guest today is Rob Chrisman. who Rob is so famous, he even has a website named after him, robchrisman.com. But Rob has got a ton of experience in the mortgage industry and currently primarily writes a daily newsletter that many of us in the mortgage industry read. And Rob, you're going to be coming up here to North Dakota. Are you looking forward to that?
I am looking forward to it. I live in California, although I've been to North Dakota. In fact, I've taken my kids to all 50 states, and they had a great time in North Dakota.
Super. All right, so, that's awesome. So a return visit for you. That's great. We'll do our best on the weather, but obviously we cannot guarantee anything.
That's fine. That's fine.
Yeah,
looking forward to it.
Yeah, all right. We're looking forward to having you up here. All right. Now we kind of talked about what the mood is like out there. One thing, one of your recent newsletters here, you had some people who wrote into you about the CFPB. Of course, is always big, and Joe and I talk about the CFPB on here and what the effect has been on the the end user of all this stuff, which is the consumer. And do you see, is there still a mood that the oversight that's being provided there is still really going to weigh down the origination business, et cetera, over the coming year?
Yes.
Okay. Short and simple answer.
I'll elaborate a little bit.
Okay.
So the CFPB, as you probably told your listeners, is a government agency which sprang up as a result of the Dodd-Frank legislation from 2010, or whenever that, I think it was 2010.
Yeah,
so anyway,
yeah.
The CFPB is with us. The CFPB is not going anywhere. It's hard to stop the momentum of anything in government, right? And so the CFPB, the Consumer Finance Protection Bureau, its stated mission is to help the consumer. And when you talk to people out there, the first of all, if they even know what the CFPB is, if they've even heard of it, and a lot of the population has not. In fact, that's an interesting exercise. If you're out and about or talking to a neighbor or a waitress or somebody, and you ask them, "Have you ever heard of this?" They'll oftentimes say no, they haven't even heard of the agency. But we in the mortgage business obviously have heard of them, and they are not going anywhere. And in fact, they've continued to staff up. They've continued to increase their examinations and increase their enforcement activities. And so it really has cast a pall over the industry. And to be truthful, when you talk to folks, really the experienced can say, we've kind of brought this on ourselves, for better or for worse. And the CFPB is carrying out some things that perhaps should have been done years ago that weren't being done. So that being said, the CFPB continues to be strong, continues to grow, continues to hire, and doesn't show any signs of letting up. Now, they are looking at other industries such as student lending, auto loans, payday lending, and the like, but definitely mortgage lending is such a high volume industry with trillions and trillions of dollars outstanding. It's definitely caught the attention of the CFPB, and they show no signs of letting up.
Yeah. Well, let's ask Joey. Do you know who the CFPB was before you just heard? No. Okay. So there's one example.
No, didn't know.
The radio producer, DJ, et cetera, did not know who they were. So there's your case right there. What I found interesting, I can't remember which day this was from, Rob, in your newsletter, but it was Alan M. that wrote this little blog that you put in, and he talked about how they went to his local MBA president, went to their congressman and plopped down the rules, 1,888 pages of CFPB know before you owe rules, and the congressperson was shocked at how much was there. So that kind of tells you that really the consumer should be aware of this agency and what they do, because they touch basically any financial transaction for a consumer.
Oh, right? Absolutely, and you could say that any transaction. Of course, they're not going to get down to Girl Scout cookies and lemonade stands and neighbors doing yard work, but the fact of the matter is they take their mission very seriously, and the consumer may not see them directly, but behind the scenes, anyone in lending can tell you that the cost of dealing with the CFPB, the cost of dealing with the rules and regulations that continue to hit the industry every week, every month, has added thousands of dollars to the cost of every loan that gets done. And that, in a perfect world, well, we're not in a perfect world. That cost gets pushed onto the consumer.
Yeah.
It's highly unlikely that a lender will absorb the costs of compliance and in dealing with the regulatory efforts that are going on out there. The lender's not going to absorb those costs in their profit margin. They'll pass those on to the consumer, and so the consumer may not directly see the CFPB's activities, but they pay for them.
Yeah. Well, you said there is some value in what they have put out there to date. Like you said, some of the people thought, well, some of the stuff should have been done before. Another one that they kind of took some heat over here lately was they put out the rate checker, mortgage rate checker, and they took to task here by like the Mortgage Bankers Association, et cetera. And I noted this week that actually Google has come out with a competitor to that rate checker that the CFPB put out there. They're putting out their own mortgage calculator. Have you heard anything about that one?
I have not had a chance to look at that. The Google, and I know we're not here to talk about Google's business policies and procedures and so forth, but they are a force to be reckoned with, regardless of what they do or what they create. And they're a monolithic company. I mean, they're huge and they make a lot of money, and so when they dip their toe into something like this, whether it's rate checker, or let's say another monolithic company like Costco says, okay, we're going to start offering mortgages, it has an impact on the industry. And it's easy to think, oh, that's not, no one's going to go to Google to check mortgage rates. Well, I think they're wrong. A certain percentage of the population will. And then the question is, all right, Google, are you charging companies to be included in that rate survey, or how are you getting that information? So that's a key point. It's not easy to scan the world of mortgages and figure out the rate and price for every instance. And an experienced loan officer will tell you that the current loans are so specific and so individualized that it's definitely more of a relationship, arguably, than it ever has been. Every loan is different. Every nuance is different. And for a borrower to go on to the Google site or any site, the CFPB site, and say, okay, my credit is this, and I want the best rate and best price, and then they get a rate and a price, and then they go to a lender with it. Well, then the lender finds out, well, their credit wasn't so perfect. Well, the loan-to-value is too high. Well, it's actually a condominium, and they didn't include that. There are different things that impact price that typically something on the internet like a Google rate checker are not going to include, and so the loan officer, unfortunately, has to be the bearer of bad news when they go back to the borrower and they say, well, you really don't qualify for that, great rate. And here's your actual rate and price.
Right.
So it'll be interesting to see what happens to that.
And that'd be it's a battle, because when you think about it, a company like Google, they're on all the Android phones, so your Samsungs, et cetera, and that's out there, and people are going to use it if they see it's there, and there's going to be that battle between that and what you just described. So it will be pretty interesting to see how far a company like Google takes this. Right.
Yeah, they certainly have staying power. But the fact of the matter is, as I mentioned earlier, the mortgage industry is so large, and there's so much possibility for income and revenue for a company like Google to dabble more and more into that. And the the loan officers out there and the originators know that it's not necessarily a commoditizable business. I don't think commoditizable is a real word, but you understand what I'm. Yeah, what I'm trying to say is that it's not. As I said, every deal is different. Every borrower is different, and you're dealing with a home, not a house.
Yeah.
I mean, a computer doesn't really understand some of these things that an experienced originator does.
Yeah. Well, Rob, I don't think we planned on talking about Google so much, but we are bumping up against the end of the time here with you. You are going to be at our housing conference February 25th and 26th. You're going to be speaking the morning of the 26th. So if anybody wants to come out and learn about the mortgage industry and what it's going on today, come and sign up for a conference and come and see Rob on Thursday morning, February 26th. And Rob, safe travels. Where are you today?
I'm in rainy Orlando, Florida, but heading back to California shortly.
All right.
So
well,
I appreciate very much you having me on.
You can wave as you go by, probably around Kansas or something. You could wave at us. But it's sunny here. It's probably not as warm as it is in Orlando today, and definitely not California. So, but anyway, Rob, we look forward to seeing you at the end of the month. Safe travels and. Keep doing what you do. We appreciate it.
All right, Dave. Well, I'll see you in a couple of weeks, and thanks again for having me on.
Super. Thank you. All right, everybody. That's our break time, I believe. Joey. All right, let's rock and roll. We'll come back at the end of the break. We'll be here. Tough game. All right, we are back on Mortgage Talk 101. Dave Flohr here, saddling up the stainless steel microphone in place of Joe Sheehan, who's on special assignment up at the oil patch. He's up at one of his branch offices up there, so he's seen what's going on in the oil patch. If there's any oil being drilled anymore, you hear some of the stories, you'd think that the oil industry just shut down, but I don't think they have.
I don't think they have.
Yeah,
Maybe.
I think there's still some work going on up there. Although some people would say, oh, no, there's not, but yeah, anyway. So anyway, let's talk mortgage interest rates. We want to thank Rob Christman again for coming on, and Rob kind of gave us the lowdown on the mood of the mortgage market out there these days. But if you have any questions for us, 663-1270, please call in. Interest rates last week, Joey, we do the Freddie Mac survey, which is a little misleading because it's an average for the week, and it ended yesterday, so it's kind of, it's a little bit slow, but it kind of works. But the 30-year fixed-rate mortgage, it averaged 3.59%. That was down from last week when it averaged 3.66%. So that sounds good, but in the last 2 days, rates have ticked back up a little bit. So, yeah,
slightly misleading, a little bit.
A little misleading, yeah. The 15-year averaged 2.92%, and that was down from last week when it averaged 2.98%. Now, a year ago, the 30-year mortgage was at 4.32%, so we're definitely down from that. Over, probably 0.5% at least, if not 75 or 0.75%. And the 15-year firm averaged 3.4%, so that's down a solid 0.5% there. So interest rates are still good, folks. I would certainly recommend, if you're looking at buying a home soon and you've got your loan application in, that you probably just go ahead and lock your rate in. It's a good time to do that. So, some other industry news here that we always talk about. I've got the MBS Highway from our friend Barry Habib. There's some reports that this is a big week for economic reports. And jobless claims are coming out and stuff. Now, jobless claims this week, was actually for the week ending January 31st, were reported at 278,000 and that was lower than the expected amount. So that's jobless claims. So there was less people unemployed than what was expected. Okay, so that's good. So it was a strong report from that fact. But what Barry mentions here is the job cut announcements jumped to their highest level in 2 years due to falling oil prices. 40% of the job cut announcements for January were energy-related, as 20,000 layoff announcements were attributed to lower oil prices. Now, to put that in perspective, the 20,000 energy-related layoffs announced for January alone is far greater than the 14,000 energy-related job cuts for the entire year of 2014. So that was a big jump. So we'll see what happens now this next month, what February's numbers end up looking like. We'll see how many job cuts actually were. I think up here, what I've read is that we had so many jobs up here that even though a company might announce a layoff, there's another company that has got other jobs available that they're still working. They're still drilling oil, and there's other work to be done. So even if you got laid off at one job, maybe there's an opportunity with somebody else, and you don't have to leave or anything. It's there. So
yeah, they're saying that there's still a lot of jobs up there in the oil patches, and even though oil prices are down, there's still companies investing billions in the Bakken still. So there's still jobs up there.
They've got
maybe not as many.
Yeah, they've got their leases. They've set up their wells. They're going to be drilling them. That's not going to stop. It's just, I think what they're talking about is some of the fringer areas. There's not maybe a lot of new exploration going on, but they know where the oil's at, where the sweet spots are, and that they're still going to be going after that. So it'll be interesting to see what happens with jobs in North Dakota with that. Now, tomorrow they're going to release the job numbers for the month of January. They're expecting 230,000 new jobs were created. But with the slowdown in the energy sector, that certainly will create headwinds for job creations, but they don't appear to be showing up in the current set of numbers. So Barry here is expecting that the job expectations at 230,000 will probably be pretty close. So that the markets will probably react positively to that, or at least not negatively. So we'll see what happens tomorrow.
So I shouldn't go sell off everything I have in my portfolio?
No, I wouldn't do that.
Okay.
Yeah, probably not. Probably safe to just hang on to it. As Rob pointed out, really the biggest thing affecting stuff happening in the United States is because of Europe and Asia. It's the Greece. The Greeks are just messing with everybody with what they're doing, and the Swiss did weird stuff with their currency and everything. So that's what's affected us more than ourselves. So we're nice to ourselves, but it's everybody else that's kind of messing with us. So, all right. Okay, now this might be interesting. No, okay, you're a younger guy. You on Facebook?
Yes.
You got Facebook? Do you use it a lot?
I am required to use it a lot, and I mean personally,
part of your job,
part of my job on the radios, we do a lot of interaction with Facebook. But I mean, even for me personally, not living in this area and having family in other parts of the country, Facebook becomes very important for keeping in touch with people. And
okay. No, we have another friend of the show here, Elliot Eisenberg. He's an economist, and we use this stuff regularly, Joe and I do. He has a website. It's called graphsandlaughs.net. This guy's an economist. He has a big bow tie. The guy he's actually entertaining as can be. He's funny. He's not what you think of as an economist. Okay, he's come out to North Dakota and spoken at our housing conference, and I believe he spoke at a home builders convention in North Dakota. So he's familiar with North Dakota. But he puts out this graphsandlaughs.net, and basically what he does, every day he puts out a 60 to 70 word blog on the economy. And he gets a lot of information in a little bit of space. Okay, now this came from last Friday, and he's talking about Facebook. There was a recently released and terribly designed study by brainless economists that was commissioned by Facebook. The social media site finds that in 2014, it created $227 billion in world economic impact and 4.5 million jobs. Elliot says, "Are you kidding? Assuming 500 million users who use Facebook 30 minutes a day, and you probably use it more than 30 minutes a day, I would guess. With your job,
with including job use, I'm probably on there closer to 2 hours. But.
Yeah, and so 500 million users use Facebook 30 minutes a day and value their time at $10 an hour. Now, you're worth way more than $10 an hour. So.
Well, I like to think so. Now. My bosses, on the other hand.
But we'll go with you're worth way more. Yeah, they value your time at $10 an hour. You have $900 billion in annual benefits, ignoring the trivial cost of running Facebook. OMG, he says. So how do you figure Facebook could generate 4.5 million jobs and $227 billion in world economic impact? How do you?
See, the world economic impact kind of confuses me. How can you monetize? What that is worldwide? But I could see where maybe some of those jobs came in because there are companies now who are hiring specific people to run their Facebook pages and to use that market as a marketing tool for their business. So I could see 10% of that maybe actual people doing that. But where do they get those numbers from?
They have a lot of ads on there. Mm-hmm. Now, do you click on the ads?
No.
I don't think I have ever clicked on an ad on a Facebook page, ever. I cannot recall doing it.
I don't think I know anybody who's ever clicked on an ad on a Facebook page.
Yeah. I just curious. Like you said, poorly designed study, probably. Mm-hmm. And he probably had the particulars on what they did. So anyway, I just thought that was interesting. It was like, boy, yeah. Okay. Smart stuff. We also do By the Numbers. Our friend Michael Higley. By the Numbers this week. Okay, well, it was Super Bowl week last week. And Joey is a Seahawk fan. You're not originally from Seattle?
No, I am.
You are originally from Seattle. You've worked in Seattle.
I've worked in Seattle.
You are a Seahawk fan.
I've been a Seahawk fan since...
Tried and true.
Tried and true since before they blew up the Kingdom.
Okay, there you go. That's all we need to know. Before the Kingdom exploded, you've been a fan.
Yep.
So that was really cool, by the way, when they blew that up.
Yeah, that was quite a moment. A friend of mine's father worked in one of the buildings, one of the skyscrapers downtown, and we got to watch it from above. So it was kind of.
Which you have a wonderful new stadium that replaced it. So.
CenturyLink is a beautiful stadium. I've had the privilege of watching football and soccer be played in there.
Super.
And
so anyway, so it was Super Bowl week. Sorry, condolences. All that.
I'll get over it.
Okay, all right. Did you know that the most expensive Super Bowl ticket for Super Bowl number 1 was in 1967? It was in Los Angeles. It cost $12. The face value, not what it actually sold for. Mm-hmm. The most expensive ticket for Super Bowl 49 this past Sunday was $1,900. So not what they sold for, because they were going for like $9,000 or something.
9, 10, 15,000. Yep.
So this is just the face value. Okay, so the increase in Super Bowl face value tickets from $12 to $1,900 for 48 years was a compound interest rate of 11.1% a year, for whatever that's worth. Kind of interesting trivia. If you go out with your friends tonight, your wife. You can lay that on them.
Yeah, there you go. That's the mundane trivia for the night. And then everybody will look at me and go, why did you need to know that?
Why'd you know that? Yeah, okay. Okay, now, here's a couple other things. I'm just going to give you a mother load here of trivia
let's
stuff
do this.
Okay, next decade. The Congressional Budget Office estimates that over the next 10 fiscal years, through 2025, the United States will take in $41.7 trillion of tax revenue but spend $49.3. So that's a deficit of $7.6 trillion. Okay. Mm-hmm. Okay. Now, the outstanding debt of the United States as of December 31st, 2004 was $7.6 trillion. So it took the United States 216 years from 1789 to 2004 to accumulate $7.6 trillion of debt. Okay. The same level of debt the USA may add in the next 10 years. Okay, that's a little mind-boggling. Now, obviously, there's a lot of things factored in there, but it's kind of mind-boggling. So that you might amaze your friends later today.
Either that, or they're going to want to punch me in the face for knowing that and making them feel bad.
And we were just talking about how Greece, is affecting things over here.
Absolutely.
Do you know that 13 U.S. states have economies that are larger than the economy of Greece? There's another one for you.
Hey.
So this little teeny country, we have 13 states that have a larger economy than and they're affecting us.
Affecting everything.
Yeah.
Well, I mean, they're affecting everything everywhere. I mean, the European Union's having problems with them. Asia's having problems with them. So it's not just us that are feeling that.
No, there's good and bad to it. Right now, it's keeping interest rates low here because everybody's like, I'm pulling my money out of there. I'm going over the United States and buy treasuries, and that's driving our rates down. So, all right. Let's see. Did we blow through the break, or we keep going? All right.
Keep going.
All right. Okay. Question for you. What's the price of gasoline in Saudi Arabia today? Per gallon.
Per gallon in Saudi Arabia, I'm gonna guess somewhere in the low $1, like maybe $1.10.
45 cents. Okay. Price of gasoline in Norway, what do you think?
Norway, let's go with $1.50.
$9.26.
I was off just a little bit.
We're at 205. I think we're a little bit higher than that in Bismarck.
Yeah, I think I think we're 209 is what the across the street.
209. Yeah.
I was just getting used to seeing it sub 2, man.
Yeah,
it was like I'm back in high school or something.
Yeah, it's terrible. Oh well. Okay. Do you know what your credit score is?
I
don't have to spout it out.
I don't.
Don't spout it out.
I hate that the number is what it is.
Okay.
But yes,
okay. You don't have to give us any clues. I just asked if you knew what it was.
Yeah.
So. Okay. Well, obviously, big deal for home buyers.
Mm-hmm.
You know what your credit score is. That a lot of is predicated on that. Rob talked about that. How consumers, you could go out to Google now apparently and check what rates are, and then you go into your lender and no, you don't qualify for that rate because your credit score is here versus where you got it from Google at, or some other the best rate out there. So credit score is important. Now the company that has the most predominant credit score service it's the Fair Isaac Corporation, and they call it the FICO credit score. I assume it stands for Fair Isaac Corporation. Okay, but that's the one lenders use to determine. Okay, what they do is it pulls in credit scores from the credit reporting agencies, which is like Experian, Equifax, and TransUnion, and there's an average. But there's 3 different scores, and the lenders will use a combination of those scores to determine, okay, where do you fall in the spectrum and what kind of rates can that get you? Now, up until this point, as a consumer, you and I did not know what the score that the lender's going to use. We did not know what that was till we went in and made a loan application, and the lender pulled that credit report and told us what it was. So we couldn't get any prior knowledge of what that was. Now, we can go out to, like my credit card gives me what my credit score is. Now, it's not necessarily what the lender's going to use, but they give me a credit score, so I have an idea, which is nice. Okay, and it's a good way to make sure and you can go out and get annual reports from each of those credit reporting agencies to make sure somebody's not opening accounts in your name. They got your social number and all that stuff. So it's it's valuable for that. But now FICO is going to release the scores that the lender is would use, and we can now access that. So if you were going to go buy a home, you could go to Fair Isaac, and you could go out and check, and you'd know ahead of time, my credit score is this, and so before you go into the lender, you'd have an idea of what that credit score is, and maybe that makes you wait because your credit score is low, and you say, well, you know what, the best I'm going to do on rates is this, so I'm going to wait until I build that credit back up. But, of course, you're going to have to pay for it.
Obviously.
Yeah.
I mean, they're not just going to...
They announced on Monday that they are selling consumers a look at certain versions of the FICO score that had now been mostly unavailable to them, including the ones commonly used by mortgage lenders. And actually, did you know we don't have just one FICO score? We have dozens. Isn't that nice to know? Did you? I didn't know. I didn't know how many we had. I knew we had more than one.
I knew about the 3 agencies that lead into it. So I'm thinking, maybe 4 different numbers or something. But
we've got dozens. We have dozens, Joey. So we really don't know what most of them are, I'm sure. So anyway, so consumers go in advance, as I said, whether or not they want to wait to improve their scores, et cetera. So they're paying, and it would be here's the fees for this service. There's various options, one-time and continuing access. The charge with a monthly subscription can be as low as $14.95 a month. And they don't specify here what a one-time request would cost. It probably costs more than that, I would assume. I don't know. Okay, and it's 200 million consumers have FICO scores, and lenders have more than 50 FICO score versions to choose from on each of us. So, okay, this is interesting. I did not know there was that many versions of this, and I'm kind of in the business here. Okay. No, good thing. The new service provides consumers with the main factors that influence each of their FICO scores. So you could look at that and see where you're falling down, so to speak, and work to improve that part of it. Now, the extra scores can also help borrowers shopping for a car loan or credit cards. There's a FICO car score. Did you know that?
I did know that.
Did you? Okay.
Only because I'm in the market for a new car, so it's a
separate one.
I had a friend of mine tell me that.
Yeah. So a FICO car score, for example, can be very different from other FICO scores, especially if borrowers have managed their car loan bills better or worse than their other debts. So I guess, okay, so you go into the car dealer and you're going to get your financing through them, or you go to a bank and you're going to get, okay, I want a car loan. So you've had previous car loans and you've paid them on time. So your car score could be really good, but then if you've handled your credit card, and say you own a house and you've got bad credit on your house loan, I wonder if they still give you a car loan then, just because your car score is better.
That's an interesting. That was the thought that went through my head. So wait a sec, I can be late on my mortgage, but if I'm always up on my car, does that mean I'm going to get a better rate or have access to a higher limit when I go for? Can I go out and get that Ferrari now, even though my...
probably not. But, I'm sure you still have to have the income. But this is very interesting to me. I didn't even know this stuff. So, not that probably surprises anybody that knows me, but I didn't. But so anyway, whether this is a good deal, I guess if you're going to be getting a mortgage, you're thinking about buying a house, you can go out and get access to the scores that the lenders are going to be looking at. So, if you go out to Google and check your rates and you say, hey, I can get a 3% rate, but only if the credit, hopefully they'll see the credit score has got to be within this range to get that. And then you go out and check your credit score and it's below that. Okay, well, I can't get that rate. So you don't have that surprise when you go into the lender. That's maybe a good thing. So we'll see how successful they are. But monthly subscription, $14.95. That's
why would you actually need a monthly subscription on that? Like, I can understand if maybe you've had previous problems with identity theft or something like that, and you want to keep on top of it. But for somebody that's dealing with this every day, like me, that I'm only going to check my credit score when it's time to get a new car, or me and my wife finally decide to purchase a house where we're living. Why that would be? I would think that a one-time shot would be more than enough. So who would really benefit from monthly access to stuff like this?
I'm not sure either. Yeah. And no, if you're looking at buying a house, I could see subscribing for a couple months or something, because it might take me that long, and I want to make sure I don't
fix a couple of things, maybe correct the scores, see if maybe you can
get
a better rate.
But it's interesting, they didn't, in the article, they didn't have what the one-time fee was. So you'd almost think the one-time fee would have to be more than the monthly, because otherwise, why do the monthly?
He's just always going in.
Yeah. So it'll be interesting to see how that works out. So, all right, another thing. Joe and I have talked about this the last 2 weeks, and I freaked out 2 weeks ago. I did. I freaked out. There's this thing. It's called collateral underwriter. I bet you have no idea what that is.
Doesn't.
Right. Okay. I wasn't expecting you to.
Okay.
But I freaked out, and then last week we determined that I shouldn't have been freaking out because it wasn't that bad.
Okay.
But this is a deal where do you know who Fannie Mae and Freddie Mac are?
I vaguely.
Okay, they're these big government-sponsored entities, and when 2008, they had all of other financial stuff, they went in the tank.
Mm-hmm.
So they're in conservatorship now under the federal government.
Mm-hmm.
And they haven't let them out. But they handle 95% of the mortgage market is through Fannie Mae and Freddie Mac.
Mm-hmm.
That's where mortgages go in one form or another. So anyway, they came out with this thing, collateral underwriter, that we've talked about that deals with appraisals on the properties and how they were going to be dictating and asking, pushing questions on the appraisers of the properties and stuff, and whether that was good or bad. Now, I found out a new word for my vocabulary also with this. This week there was an article, appraisers are, and do I get in trouble if I use the word?
No, you're good on that one.
Okay, all right. Okay, are pissed with collateral underwriter. However, it's not the pissed you think it is. It's the P-I-S-T. Have you ever heard of this word?
No.
Okay. P-I-S-T, it's an adverb, not to be confused with the other.
Mm-hmm.
Okay. Pissed can be used as an adverb or interjectionally to describe something as extremely good or bad. That seemed kind of like you got to take it in the right. How do you figure out the context? Whether he's pissed at the collateral underwriter, but is that happy about it? Is it a good bad thing? I don't.
So unless you're looking at their face while they're saying it, you don't really know what they're doing.
Whether it's meant to be taken as good or bad depends on the tone in which it's used. So you either have to be polite or angry, I guess, when you use this word.
And just hope that you don't read it and wonder what they were saying.
Exactly. Yeah. So we're learning all kinds of stuff today. So anyway. But anyway, they said this is still causing some angst out there in the mortgage industry because it is causing some questions. So maybe Joe and I will talk about it next week. We're almost done, aren't we?
We are.
Okay.
Just a few more seconds.
All right. Thanks, Joey. Everybody, Mortgage Talk 101, Dave Flohr signing off. Hopefully Joe and I will be back next week. Joey, thanks for running everything today.
No problem.
We'll see everybody. Have a great day, folks.